Welcome to this explainer. Listen, today I want you to consider me your senior analyst, maybe even that older brother in the finance world. We're heading right into the dark side of the market. This is the exact place where your standard, textbook, discounted cash flow models, yeah, they go here to die. We're looking at those weird, special situations where the normal rules just absolutely break down. And trust me, if you aren't armed with the right frameworks, these types of stocks will literally tear your portfolio apart. So, we are going to dive deep into Aswath Damodaran's methodology to see exactly how the absolute pros handle these complex anomalies.
So, let's hit the whiteboard. We're going to build you a custom framework for these complex sectors. Here's our agenda for today. We'll start with banks and financial firms, then move on to cyclicals and PSUs. After that, we'll tackle loss-making startups, holding companies, real estate, and asset-heavy businesses before wrapping it all up with your master toolkit.
Let me give you some tough love right out of the gate. Blindly applying a standard DCF to every single stock you see is a surefire way to make massive valuation errors. I mean, standard DCF just does not work for every company. Banks, cyclicals, tech startups, they operate by entirely different sets of rules. You can't just force a square peg into a round hole, right? The actual mechanics of cash flow and capital expenditure means something completely different depending on the sector. You need a specialized toolkit to uncover their true intrinsic value. Get this right, and you find hidden value. Get it wrong, well, you're left holding the bag.
All right, Section 1, Banks and Financial Firms. These guys are a completely different breed.
Let's dive right in. If you try to calculate free cash flow or a standard weighted average cost of capital, your WACC, for a bank, you are instantly going to hit a brick wall. Why? Well, think about it. For a normal company, debt is how they fund their factories. But for a financial firm, debt isn't a source of capital. It's literally the raw material they use to mold into their products like loans. So scratch WACC entirely. Throw it out. Damodaran's absolute favorite trick here is the excess returns model. We take the book value and we add the present value of excess returns. You find that by taking the return on equity, subtracting the cost of equity, which is just the baseline return investors demand for taking on the risk, and then multiplying that spread by the book value. It's brilliant. It calculates exactly how much return a bank is generating above our basic expectations.
Now, if you're going to use multiples instead of building out a full model, price to book is absolute king here. Bank assets are frequently marked to market, right? And this metric brilliantly illustrates why a bank like HDFC commands such a massive premium. It trades around a price to book of 2.8, and that's because of extraordinarily high asset quality, phenomenal management, and very low non-performing assets. Now compare that directly to SBI. SBI trades at a structurally discounted 1.7. Why? Because of its massive, unwieldy size, its lower historical asset quality, and honestly the persistent risk of government interference forcing them to prioritize unprofitable lending. The multiple perfectly reflects that excess return reality.
Moving on to Section 2, Cyclicals and PSUs, where it's all about surviving the swings.
This sector is a totally different beast. It is all about surviving massive, violent earnings swings. For cyclical and commodity companies, their earnings jump and crash based on external macro factors that management simply has zero control over. We're talking interest rates, global supply chains, wild raw material shortages. So trying to calculate a standard terminal value here, it's incredibly dangerous. Damodaran points out in his research that extrapolating a cyclical company's most recent fiscal year is a total rookie mistake. If that recent year was a boom year, your valuation is going to be artificially sky high. If it was a bust year, you'll swear the company's going bankrupt. You have to remember, their fate is tied to economic ups and downs, not just internal performance.
Let me give you a real-world example so you can see just how devastating this mistake can be. Take Tata Steel. During the fiscal year 22 global steel boom, they posted this absolutely staggering peak profit of roughly 40,000 crore rupees. 40,000. Now, do not fall into the trap of using that peak as your base year for a DCF. If you do, the stock is going to look ridiculously cheap, but it is a total mirage. The cycle always turns. You have to normalize this down over a full economic cycle, usually taking a 7 to 10-year average. Doing that brings their normalized earnings way down, closer to 15,000 crore rupees. That normalized number, that is the realistic baseline you have to put into your model to actually survive the swings.
And what about pure commodity plays, like oil companies? Well, we have to look completely past current spot prices. Using probability distributions, like an Exxon oil price simulation, lets us account for the sheer unpredictability of the market. Instead of just guessing one static oil price forever, which, let's face it, is guaranteed to be wrong, we simulate thousands of scenarios across the entire cycle to find an expected intrinsic value per share. It's really all about modeling probability, embracing the uncertainty, and definitely not projecting some false sense of certainty.
And if we're analyzing public sector undertakings, PSUs, like Coal India, you've got a very unique set of quirks to map out.
Many of these government-backed entities are just absolute dividend machines. Coal India has historically pushed a 10% yield, so using a dividend discount model works wonderfully here instead of a traditional DCF. But, and it's a big but, you absolutely have to factor in two massive risks. First, government interference. Political decisions can suddenly mandate subsidies or alter operations entirely at the expense of minority shareholders. Second, ESG concerns. As the world shifts toward renewables, fossil fuel giants face a structural decline. That means you have to apply severe ESG fade discounts to their terminal value. They aren't going to grow into perpetuity. Their cash flows literally have a ticking clock attached to them.
Okay, let's keep moving. Section 3. Loss-making startups. Valuing the future. Let's wipe the whiteboard totally clean for this one. We are trying to value the future here, and frankly, it's the toughest puzzle on the board. With young, high-growth companies, standard DCF just completely falls apart. Why? Because there are literally no positive cash flows to discount right now. So your first framework here is the project to profitability roadmap. Step 1, you have to honestly, brutally model the operating losses and cash burn rate for the first few years. Don't sugarcoat it, startups bleed cash. Step 2, model a transition to break even, usually hitting that around year 4 or 5 as customer acquisition costs start to stabilize. Step 3, project robust profit growth as revenues scale and unit economics actually kick in. And finally, step 4, transition them into a stable, mature company to calculate your terminal value.
But honestly, my absolute preferred method for these insanely volatile startups is using probability-weighted scenarios. You just can't pick one single path. Take a company like Zomato. You map out a massive bull case. Let's say there's a 60% chance they become the dominant, unstoppable market force in food delivery, hitting a 250,000 crore market cap. But you also have to aggressively map out the bear case. Maybe there's a 40% chance they get crushed by aggressive competitors, burn right through their runway, and end up at a mere 15,000 crore valuation.
So what happens when you do the math? This is the crucial part. You multiply the scenarios by their probabilities and blend them together. 60% of that massive success plus 40% of the failure gives you an expected future value of 1,56,000 crore rupees. Then you discount that specific blended number back to today. And you know what? This brilliantly explains why early-stage stocks, especially newly listed IPOs, have such wildly wide and confusing valuation ranges. When an IPO drops, there's hardly any historical data. Investors are just constantly adjusting those success probabilities in their heads with every single piece of breaking news. Literally, a tiny shift from a 60% to a 70% success probability creates a massive swing in the stock price.
All right, Section 4, holding companies, the sum of parts. Let's tackle our next special situation. Holding companies are all about the sum of the parts and uncovering why the whole is surprisingly worth less than the individual pieces. Their primary asset is just owning stakes in other businesses, but they notoriously trade well below their apparent aggregate value. To crack this, we meticulously run the SOTP, or sum of the parts framework. First, value each subsidiary completely independently. Use the market cap if it's publicly listed, or run a ground-up DCF if it's private. Second, add the holding company's standalone cash and investments. Third, subtract any outstanding debt at the parent level. And fourth, this is the absolute most critical step. You must cleanly execute the holding company discount.
Now, you might be wondering, why discount it at all? Why not just pay full price for the sum of the parts? Simple, intense structural friction. There are heavy tax inefficiencies if the holding company ever tried to sell those assets or distribute the gains to you, the shareholder. On top of that, there's often a lack of direct operational control over those subsidiaries and severe illiquidity when holding massive blocks of stock. In a market like India, this discount typically ranges from 30 to 50%. For example, Tata Investment Corporation might sit on 50,000 crores in underlying undeniable asset value, but it routinely gets hit with a 30% discount on the open market, bringing its actual fair value down to roughly 35,000 crores. If you don't apply that discount, you are quite literally overpaying.
Next up, Section 5, real estate and asset-heavy businesses, the waiting game.
Real estate and asset-heavy companies require immense patience. You need a completely different accounting mindset to value them properly. See, their book values are mostly locked up in these massive, illiquid land banks that don't generate cash immediately. Plus, think about the timeline. A single real estate project cycle, from buying the land, fighting for zoning permits, actual construction, all the way to final handover and sale, that takes anywhere from 5 to 7 years to complete. Getting the exact timing of those future cash flows right is literally your only path to an accurate valuation here. You aren't just predicting how much profit they'll make, You're predicting exactly when that cash actually hits the bank account. A delay of just 2 years on a massive project, that can absolutely wreck the present value of those future cash flows because of the time value of money.
Finally, Section 6, the Master Toolkit, your next steps.
Wow, okay, we have covered a huge amount of ground in this explainer today, hitting the whiteboard hard across multiple, very distinct sectors. But the core lesson from Damodaran's dark side is incredibly clear. One size absolutely does not fit all. You are now fully equipped with the mental frameworks you need to be a true senior analyst. For banks and financials, throw out WACC and use the excess returns model. For wild cyclicals and commodity plays, normalize your base earnings over a full cycle so you avoid those top-of-the-market traps. For high-growth startups and volatile IPOs, build out rigorous probability-weighted scenarios. And for holding companies, run the sum of the parts and apply those harsh, realistic discounts for liquidity and tax friction.
The market is packed full of dangerous special situations, just waiting to catch the unprepared investor totally off guard. Standard metrics? They will lie to you if you apply them blindly. So the ultimate question I'm leaving you with today is this. Will you stay stuck using a broken standard DCF model that traps your portfolio in false valuations? Or will you step up, do the hard analytical work, and use your new custom toolkit to uncover the market's hidden value the very next time you encounter a weird, complex stock? The tools are literally right in front of you. Get out there, test these models out, and whatever you do, don't be afraid of the dark side of valuation.